We're looking for decreased volatility or risk, and we're looking for increased returns. So what I'm seeing is over in the far right there, an 80 stock, 20 bond portfolio, going back over 20 years, you've seen produce returns that are really strong and exceptional, returns of over 8%. With that, you see the volatility being the highest here on the right, and that volatility is over 13. If you pair the stock allocation from 80 to 60, and you take that additional 20% and move that to alts, it's pretty amazing what happens. You don't give up performance. You actually increase the performance slightly from an 8.2% average annual return to 8.5, but you decrease the fluctuation. You decrease the volatility from a 13% per year to a 10% per year. That middle piece, the traditional diversified portfolio that I grew up in the industry early 20 years ago, learning about a 60-40 portfolio that's been very well documented as providing somewhat consistent returns. Again, we showed that in 2022, stocks and bonds were both down 10%. So that diversification was not working at its best there. 60 stock, 40 bond, average return, 7.3%. Volatility of 10. You drop the stocks from 60 to 50, you drop the bonds from 40 to 30. You take that 20%, transition it into the alternative portfolio, you see a significant increase in performance over the last 20 plus years, 25 plus years, and you have a performance that's averaging still over 8%. The volatility drops down as well. Do you see the alts coming out of favor, or do you think the next 25 years might look similar to this?
I think it will be very similar going forward, and I think, we'll get more into what is going on under the. There's less correlation between the assets that we. There's the drawdowns aren't as. I think one thing that's interesting is that I know at Ausperity, and I think most advisors are the simplest, most fundamental investment objective that they should have for an investor is keep their goal in mind. Income as a growth. Really, is the construction of a well-diversified portfolio. So private markets improve the potential for diversification, and diversification is really the only free lunch. So if you're in, for example, a public-only investment, then on the fund we were showing before, there are 3,000 loans that you're missing out on the private markets. For example, that would be diversifying your portfolio. And so the more diversification if you follow Markowitz or any of the sort of PhDs that have studied portfolio construction, diversification is really the only free lunch. And I think that will never change. So that's why I think this will be true. I do think that through financial crises, through crises, this is when it's most important, when you have a diversification. But when the market's doing great, you see it less. And so this is why it's important to look at it over long.